In this video, I'm going to show you exactly how a mortgage escrow account works. I'm going to show you where that money goes, what schedule it's paid out, and also I'm going to show you exactly how that escrow account is established on day one when you first buy your house. I go through this in detail with all of the home buyers that I work with. It's especially confusing to first-time home buyers, so I hope this video gives you clarity. Let's jump into it. I will start off by saying that an escrow account for taxes and insurance is optional if you're putting 10% down on a house or more. If you're putting less than 10% down, lenders are going to require that your taxes and your insurance go into an escrow account, which means they're collecting a fractional amount for property tax and homeowners insurance and mortgage insurance as part of your mortgage payment every single month. Another thing I want to point out is rent versus mortgage. When you're paying rent, you pay rent on the first for the month ahead of you. When you pay a mortgage, you actually pay your mortgage interest in arrears. So if you close on a house and you buy it in July, we collect July's interest during that month, and then you won't have a mortgage payment until September 1st. When you pay your September 1st payment, it pays August interest. Remember this for later. So by using an escrow account for your taxes and insurance, it simplifies your household accounting. So when you pay your mortgage payment each month and you have an escrow account, part of your mortgage payment is going into that escrow account, so the lender has the money to pay your property taxes and your homeowner's insurance renewal when it's due. So this is the impound schedule for property taxes in California. You can see that the first installment of property taxes is due November 1st and delinquent on December 10th. The second installment is due February 1st and delinquent April 10th. So during these time periods, the county is going to send a tax bill to your house. If you don't have an escrow account, it's your responsibility to pay those bills when they show up. If you do have an escrow account, the county also sends a copy of the bill to your mortgage lender, and the mortgage lender uses the money that's in your escrow account to pay those bills when they're due. So let's jump in and see what your mortgage payments are made up of. For this example, I'm using a $400,000 home with a 5% down payment. Today's rate is 6.99%, which gives you a principal and interest payment of $2,525.60 per month. Down below that, we can see the monthly property tax amount is $416.67. For this example, I'm using a homeowner's insurance policy that's $900 a year, which means you're paying $75 a month as part of your mortgage payment to put into your escrow account. And the mortgage insurance payment in this example is $117.17. So your grand total monthly mortgage payment that you pay to the mortgage company is $3,134.44. So when you first purchase your home, we are going to collect a full 1 year's homeowner's insurance policy, which in this example is $900 a year. So we collect $900 and we pay that policy for 12 months. The reason that you're paying $75 a month as part of your mortgage payment is $75 a month goes into your escrow account, so that 12 months from now, there's $900 sitting there to renew your homeowner's insurance policy. Same thing with the property taxes. Remember, the property taxes are due twice a year. So for the purpose of this example, we always use 1.25% of the purchase price to calculate your property tax. So on a $400,000 home, it's going to be about $5,000 a year, which is due in 2 installments of about $2,500 each. So we're going to collect whatever tax is due at the time that you purchase your home. Now, again, each month as you make your mortgage payment, we're going to collect $416 to replenish that account so that we can pay those next installments as they come up. So I always get the question on closing costs. Because we're collecting a certain amount of property tax up front, people see this big line item in their closing costs and they're like, what's that fee? This is not a fee. We're just collecting property taxes in advance to pay that bill. So remember my example of closing on a house in July. If you close on a house in July, your first mortgage payment isn't till September 1st. So you're going to make September, October, November. That's only 3 payments before the property tax bill is due. So we're going to collect some money up front for the property taxes so that we can pay that bill when it's due, and then your mortgage payment each month is going to replenish that account. Now, it is the responsibility of your mortgage lender to go through and audit this account once every 12 months. So when they go through, as we know, property taxes and the cost of insurance can go up over time. So when they analyze this escrow account and they find out that they have too much money, they might issue you a refund check. But to the same note, if they analyze the escrow account and there's a shortage, they can actually adjust your mortgage payment up to make up for that difference. So if you ever have any questions, or if your mortgage payment changes, if you get an escrow notice from your lender, you can always call the servicing department and ask them to send you details of your escrow account analysis. And usually on your mortgage statement, there's going to be a summary of your escrow account balance as well, so you can monitor it each month. You can also click the link down in the description to view an interactive presentation that shows all of these numbers and the screenshots that I used in the example. Also, if you have any questions, feel free to leave them in the comments. I'm happy to answer those, and I will be monitoring them over time. I hope you found this video helpful, and please let me know if you have any ideas about videos that you'd like me to do in the future. And if you're on Instagram, please give me a follow at LendPro. Have a good day.